Well, it's going to be a very important and very interesting earnings report from Facebook. The market and certainly the sell-side analysts have fallen back in love with Facebook. If you look at the price action, the nice melt-up that we've seen from just shy of $115 back in late December, the market now is a belief that the stock is still very cheap. You can buy Facebook on 24 times forward earnings. If you compare that to the internet sector on 30 times earnings, Facebook has never been this cheap. We've seen earnings being ratcheted up by sell-side economists, sell-side analysts, and that's a reflection of the strong outlook that we've got for the company at the moment. If you look at their enterprise value to EBITDA, it's trading around 13.7 times. The price to earnings growth ratio is a very compelling 0.7 times. So from a valuation perspective, it looks really interesting, especially with the levels of growth that we're expecting from the company going forward. For the full year, and I think this is very interesting, we need to look out for whether the company is going to beat $5.23. That's a really strong level of earnings per share growth for the company. $36 billion worth of revenue from that company as well for the full year, and that's what we're really gunning for. The concern, of course, has been that we're going to see a slight slowdown in ad revenue for 2017. So let's have a look out for the outlook on that. At the moment, we expect to see ad revenue growing around 39% for 2017, and that'll probably slow down somewhat to around 33% ad revenue growth for 2018 going forward. Now, in terms of the specifics for Q4, the numbers that we need to key off for, earnings per share, the market's expecting 113 cents or $1.30. That's about 19% growth there. In terms of revenue, $8.49 billion. That's about 21% year-on quarter-on-quarter growth, about 45% revenue growth for the year. Most of that obviously is going to come down to ad revenue growth there we've been seeing from their online platform. Gross margins will be very important because we've seen that huge increase in operational expenses or OPEX, and will that potentially impact that going forward? But gross margins expected to be about 87%. So you can see the real profitability of the company with those 87% gross margins coming forward. So these are the things that we really want to key off and beat. Now, we need to also remember that Facebook has a really strong pedigree of beating earnings per share revenue growth. In the last 8 quarters, we've seen an EPS being beaten by an average of 12% and revenue by about 3%, although if we look at the share price reaction back in November, it's a little bit disappointing. But the average share price gain that we've seen over the last 8 quarters has been about 5%. So this has a really strong pedigree around earnings season. I think from an investor perspective, you want to be in a stock which is not just cheap and has a really good earnings profile, growth profile, but one that has few surprises when it comes to earnings season. I think that's really what we're going to be seeing. Now, in terms of the outlook, I think obviously all eyes on OPEX and operational expenses and really about headcount, but also whether the investments they're making are going into profitable parts of the business. If you look at Instagram as well, I think this is something that the market's really underpricing. These guys have 600 million daily active users. They've got 1.5 million business profiles on their books, and you can see the levels of advertisers they have are growing by the day. That's around about 500 million. So I think the revenue growth coming through and the contribution from Instagram is being widely underreported by the market and undervalued by the market as well. Let's have a look at what the presidential elections portray into the stocks. I think that's going to be a really nice boost for them. And I think in terms of the projections for levels of ad spending, daily active users, which are currently around about 1.79 billion active users, and I think that the increase that we're going to be seeing there, the impact that we're going to have on live ads and live video streams, will continue to push this stock going forward. I really like the stock longer term. I think if we get a break above 133.84, which is the all-time high, we can push into these consensus 12-month targets of just over $150. I think that's really where we're going to be seeing this stock trade over the next 12 months as we realise the value that's on offer within the stock and the strong catalysts going forward, the strong balance sheet and the fairly low risks that we have for the stock, although there are risks, of course. I would get out the stock on a close below the 60-week moving average, which sits just shy of around $114 at the moment. That, to me, where we've seen really strong support kicking in. So a weekly close below the 60-week moving average, and I think that's the point where you say that you're wrong, the investment's a poor one, and that's where we can get out the trade. But I think the stock goes higher on a number of the catalysts that I've talked about there, and I think it goes above $150 over the next 12 months.